Good afternoon. I want to start by answering the question, why should asset owners care about the Sustainable Development Goals? And I've tried to summarize it in three main reasons. The first one is because they're inherently aligned with the concept of responsible investment and long-term investment. The second one is, as Nathan just explained, they potentially represent a 7 trillion investment opportunity. And then the last one, they offer us a really robust, universal language to communicate with different stakeholders outside of the investment industry. So unpacking this a little bit, I think it has come up in a few of other sessions that as asset owners, we are constantly thinking of how to improve the financial futures of our members. And we're aware that the financial future is not only comprised by the dollar value that they retire, when they retire. We realize that the world in which they retire on plays a big role in that financial future. To put it simply, there's no point of retiring with a large balance if you cannot buy the products that you want to buy because in the supply chain somewhere in Equatorial Africa hasn't been able to provide that product that you like. Or if you just can't have enough drinking water when you retire. So I think this is one of the main reasons where asset owners understand that a healthy economy, society, and environment are important for our members. Also, as universal owners, we're quite diversified, and we're basically invested in a slice of the global economy. So there's no way we can really mitigate all risks, and that means that having a healthy environment and economy is important for all our investments to thrive. So we believe that the SDGs provide us with a system-level thinking about how growth and a sustainable economy would look like. So if we manage to achieve the Sustainable Development Goals by 2030, it would be a reflection of that growth has been sustainable and looking towards a healthy society and economy. Second, thinking of the SDGs as an investment opportunity. If we think of the SDGs as a global policy roadmap, and I don't think very often we have 193 countries agreeing to a set of policies. As Nathan explained, it's 17 goals with 169 targets underneath. So it's pretty specific. So it's a set of policies and a policy roadmap for investments. So if we think about it from the investments that are going to be above and that are going to be contributing towards the SDGs are potentially going to be favored by policies, and the investments that don't fit into that are going to potentially in 2030 not have a place. So I think that as asset owners, we have a pretty interesting but challenging task of understanding how do we access those markets. And a lot of the investment opportunities are large infrastructure projects in the developing world, which traditionally asset owners and large institutional investors have not been able to effectively access. So I think that that's a really interesting challenge. It's a great opportunity, but a really interesting challenge that will require a lot of partnerships. And finally, the SDGs, and we don't have a slide with the colors, but you've probably seen how good the logos are and how good the colors are. They provide us with a really easy way of thinking of the real impact of our investments. I'm originally from South America, and whenever I go back home and I try to explain to my grandma, what do I do for a living? And I try to say, I work in ESG integration, trying to think how we integrate climate risk in asset allocation. It's pretty complex and potentially a bit underwhelming for my grandma to hear the potential impact of my work. And then imagine that translated to Spanish. It gets even more complicated. So But if I manage to tell her that the ESG integration that I do leads us to potentially select companies that are contributing to solving the problems that have been raised by the Sustainable Development Goals, I think it's a very different story that we're telling. So they provide us with a language to communicate the real-world impact of the work that we do. So with that in mind, what has been the HESTA journey? And I think it started last year when our board got together and started thinking, and they applied a bottom-up, top-down approach for selecting a few SDGs that we thought they were more relevant. I think it's important to bear in mind that the SDG 17 talks about the partnership of the goals and that there's no point of achieving one if you're not achieving all of them. And having that in mind, and having in mind the fact that we overall, as owners, should worry about the partnership of the goals, HESTA has selected a few that are a bit more strategic, applying this top-down and bottom-up approach. So from a top-down perspective, we looked at what are the things that matter the most for our members, and what are specific topics that are investable and that we can contribute to, and that are aligned with our broader advocacy positions. And then from a bottom-up perspective, we actually did a mapping of all our portfolio across listed and unlisted assets, and identified the most material risks in the portfolio. And so this analysis led to the selection of 7 SDGs. So they are SDG number 3, which is good health, SDG number 5, which is gender equality, SDG number 7, access to clean and renewable energy, SDG number 6, which relates to clean water, number 7, which is, have I missed? I'm getting confused. Number 11, which is infrastructure and sustainable cities, and number 13, which is climate action. So having these strategic SDGs is helping us shape our responsible investment, our advocacy, and our corporate responsibility policy. Following this work, we also use the Sustainable Development Goals to develop a threshold and to develop what we call an impact baseline. So we use the SDGs as a threshold to determine which ones of our investments are actually contributing in a positive way and are generating a positive impact in the world. And we were quite strict in the way we did this impact mapping. So we tried to stick as closely as possible to the spirit of the SDGs and looked at the underlying targets and mapped I think it was close to 64% of our portfolio, including listed equities, unlisted private equity, and infrastructure, and we mapped it against those targets. And it was a challenging task, and especially because we didn't want to get involved in what one of my colleagues calls rainbow washing. So if you think about greenwashing, rainbow washing is potentially just using the SDGs without necessarily contributing meaningfully to them. So we divided our portfolio into SDG contributors and SDG non-contributors. So to give you an example of how we did this, if one of the targets relates to building telecommunications and internet for least developed countries, we really took in mind the concept of the beneficiaries of that telecommunication and internet being focused in least developed countries. So it wasn't any developing country, it was the least developed countries that have been determined by the UN as needing most access to telecommunications and internet. So we're quite particular in how we did it. Another of the challenges that we face is that we realized that you could be doing a great contribution to one of the SDGs while at the same time impacting negatively another one. And to be honest, at the moment, there's not enough data available to be able to get to a net impact or net benefit of a company. So we've used proxies for that, and we've used proxies such as ESG scores, or if the manager that holds those assets have a good ESG track record, we would count those in. But that's one of the challenges at the moment of measuring and mapping against the SDGs. So a few of the results were that 50% of our SDG contributors were contributing to SDG number 7, specifically indicators 7.2 and 7.3, which talk about a transition to a lower carbon economy. So there were access to renewable energy and also energy efficiency. That is not surprising given that HESTA has had a long track record of investing for a lower carbon economy. So we have a significant amount of infrastructure in renewable energy. Other of the results are we have a large exposure that has been intentionally towards medtech, and the life sciences industry. So we map those companies, and they're mainly in early stage venture capital, or private equity. So we map those against the targets in SDG number 3 that refer to good health. Not all companies contribute to that SDG, only the ones that specifically target the diseases that have been flagged or the conditions that have been flagged in SDG number 3. And then finally, HESTA has, and we're very proud of our impact investment program, which focuses in part investing in social and affordable housing. And that contributed directly to SDG number 11, which talks about sustainable cities and sustainable communities. So this impact baseline will eventually help us to track progress year on year. So as I mentioned, how are we using this work to communicate with our members? It provides us with a better language to give better stories about the work we're doing. HESTA launched a new initiative this year called Hestia Impact, which aims to have a more holistic approach to the impact that we as a fund have in the real world. And this comprises the work that we're doing through responsible investment. So that includes investments and active ownership activities. And it includes also the work that we're doing in our advocacy and public policy. And finally, the work we're doing more from an operational corporate responsibility perspective. And so the SDGs allow us to tell a very comprehensive story of how, through each one of those tools, we are impacting the world to each one of those SDGs. So as we speak, the team back in Melbourne is working in our annual report, which hopefully would be very nicely and integrated and will include HESTA's 7 strategic SDGs and be able to tell a better story. And I think this is part of the idea of engaging our members and getting them more interested in what is actually in their portfolios and how their portfolios are actually contributing to the world they're currently living in and the world of the future. So thank you very much. Hopefully we can have a good discussion after this.
Thanks for your remarks. Just a quick question for you from the audience through the app.
Already?
Yeah, just to warm things up. Are there material differences in how important your fund members view ESG, and let's say ESG and SDGs for the purposes of this panel, depending on the demographic they fall into? So are there differences, material differences in how important your fund members view, let's say, these issues, depending on the demographic they fall into?
So I'm wondering if that is speaking a little bit of potentially age differences. And I think it's no surprise that millennials have been a lot more engaged with the world they live in and the future and climate change and inequalities. And I think, in a way, those groups might have a bit of a different view than maybe a bit older groups. I don't have the data behind it, but I think that certainly the SDGs would be aligned with what that younger generation is interested in.
And maybe the question that follows from that, if I may, is when one demographic part of your membership wants something in the way you manage their money, can you apply that learning and that investment approach across your portfolio? Or is responding to some of the SDGs notionally responding to a particular demographic? Does that introduce investment ideas and problems that you can't solve for other parts of your beneficiary base?
So just to be clear, our 7 strategic SDGs are not based because one specific group has requested them. I think they offer a more holistic view, and while that might be, our members' views and our members' interests obviously are considered into that discussion. It's a bit of a broader conversation of what is our interest, and as I said, it's a lot of top-down and a little bit of that bottom-up approach to what is material and what is investable. So I think it would be one of the characteristics that we take into consideration, but it's not the only one.
Okay, that's terrific. Thank you very much. All right, Maurice, please, can we have your remarks? Thank you.
Great. Well, welcome everybody. As my accent will give away in 1 minute, I'm Dutch. I represent the Dutch asset management firm, so I can't speak on behalf of members, of clients, but I can give you a perspective, a more global perspective, European perspective, as it's generally perceived that we're more advanced on some of these topics in Europe. I'll leave that conclusion up to you. But it's definitely a topic that resonates very well with some of the large asset owners in Europe, in Scandinavia, Northwest Europe in particular. And today in this speech, I would like to highlight some of these conversations that we have, but also share the roads that we have taken with some of them. And to put it in a slightly longer perspective, I put together this slide. And actually, this is very global. There's also a couple of Australian funds on this slide. And you can literally read this slide left to right as some sort of evolution, how we have started 10, 15 years ago when we were talking about sustainability investing. Most people thought of exclusions and negative screening. And that is still, I would say, the bulk of how many asset owners, but also other investors, think of sustainability investing. Some of the trends that we have seen there, it's often based on norms, on aligning the portfolio with the interests of the participants. Tobacco is a major theme at the moment. Particularly has started off with healthcare plans, but has become more or less a universal exclusion. Can be linked to certain religions and religious aspects in terms of alcohol, gambling, things like that. Another very topical exclusion is thermal coal. Has come up with some of our clients here in Australia, but also elsewhere. So you already see with some of these exclusions, even though they are not directly linked to the SDGs, you do see that they are very thematic. And there's a clear, often alignment between participants of the funds and how these filters are chosen in the investment policy. The last 10 years, we've seen a tremendous pickup in ESG integration, partly thanks to PRI, who's been a key driver in that whole process, but also as clients are expecting by now that asset managers like ourselves do include environmental, social, and governance factors in their decision-making for their investments. Also there, the more recent trend has become to make those effects of ESG integration much more tangible and measurable. So often you see specific targets in terms of, for example, a portfolio score on ESG. You can look at MSCI or Sustainalytics. They provide scorings on a portfolio. You compare your portfolio with ESG integration with that of the benchmark. And some participants, some clients have asked for at least a 10% higher score for that portfolio. And they want to see a tangible impact of the ESG integration. So we've moved away from just ticking the box. We do ESG integration, it's fine. No, we see that clients do really want to see what the impact is of that ESG integration. And that then moves to the last part, and that is about making a difference, using sustainability investing much more as an opportunity. Yeah? Having direct impact, talking about the SDGs in a moment, but also, for example, and again, in Australia, we've seen quite some examples of that, footprint reduction, CO2 emission targets, to see a concrete reduction in CO2 emissions for the investments in a certain portfolio. So there's a clear trend towards more KPI-driven sustainability investing, making things much more transparent, much more clear. And that brings us to SDG investing. And how does that relate to ESG? Where does ESG stop and where does SDG start? I think it's very much a continuum. They're very much related. You could say that ESG integration, at least the way that we typically perceive that, is still about the financial returns, but we use ESG information to enhance our decision making, take a certain balance in terms of what we invest in and what we don't invest in, while the SDGs are much more about the ultimate goal, the impact. So if we say sustainability investing is about financial returns and more being the socio-economic impact, then the SDGs provide that framework to really give that impact a much more meaningful, much more concrete measure. So that's how we look at these SDGs. And Daniela was looking for this picture. Well, here it is. Indeed, very colorful. And it's, as mentioned, not just 17 goals. There is that layer below that with targets, and then there's over 300 KPIs. And it's even more complex than that, because some of these goals can actually be conflicting. Some of them actually are positively correlated to growth. If we want to strive for zero hunger and no poverty, well, more likely than not, that means more growth. And how do we deal then with the impacts on our environment, on water, etc. So there is a high degree of complexity there. And that is the kind of conversations that we have had with some of the asset owners in the Netherlands, in the UK, where some of them have chosen to only focus, and that's a bit like what Daniela told for HESTA as well, to focus on a few of these goals. So rather than to approach this as a very holistic approach, let's just focus on a few of those where we feel we can have a direct impact. What is interesting in this whole discussion with asset owners is that while ESG integration, voting, and also the exclusions are generally left to the asset managers by now, and most of that is outsourced. This thinking about SDGs is still very much kept with the asset owners. It shows that there's a clear alignment with, well, what their clients or their participants ask them to do. So there's that fiduciary duty that they feel that they first need to figure out exactly what is in the interest of their participants. So we're not yet at the stage that we see major mandates that are SDG related. That might be a next step, but at this moment in time, it's very much a thought process that happens at a board level, at a trustee level, thinking of this framework in terms of where can we have an impact, what is truly aligned with the interests of our participants, but also there could potentially be a conflict with returns. And that's a very interesting one. So you might have a very positive impact via your infrastructure or investments, but how about your return there? Is that the best investments for your participants? And that, again, probably explains why this is still very much debated among the asset owners, rather than a final product. We're not at the end of this process yet. What we do already have started to see is that some asset owners have given quite explicit targets how much of their assets they want to allocate to SDG-related investments. And at first, you typically see that most of these investments are very specific, often more private equity related, whether it's in infrastructure or in clean tech. There was definitely a first wave linked to very specific SDGs. But now, for example, some of the larger Dutch plans have said we want to allocate at least 10% of our overall portfolio to SDG-related investments. So again, we talk about KPIs. We make things very concrete. And that means you have to think more broadly. So we now start to see a move away from these thematic niche strategies into mainstream. A global equity mandate that is linked to the SDGs or fixed income. And particularly fixed income, my second part of the presentation delves into that very briefly, is an interesting one. And that's different here in Australia, but most of the Dutch funds still have the majority of their investments in fixed income. So if you really talk about having an impact, you also need to consider your fixed income portfolio from an SDG perspective. And one of the difficulties there, obviously, is part of the fixed income markets is non-public, a private market. How do you get the data? How can you link your investments to those SDGs? Now, together with a couple of groups, including a couple of asset owners, we have developed a framework where we look to map the investments that you would make in a global credit mandate or a global ag-related strategy to the SDGs. Now, you can already imagine that this is, therefore, at a different level from what Daniela talked about. Those were very specific investments in social housing, building infrastructure in Africa. That's not what we talk about here. This is more with the overall portfolio to still have that positive bias, that positive contribution to the SDGs. But particularly for fixed income, which is typically not the first thing on people's mind when they talk about sustainability investing, let alone the SDGs. If we talk about these trillions of investments that are needed, yeah, a lot of that will be debt financed. So it's definitely also from a fixed income perspective, a very interesting opportunity in years to come, how to think of your fixed income investments in that SDG framework. And this framework, we try to shy away from a rather superficial approach that a food manufacturer is contributing to SDG number 1. Now we actually go very deep in looking at the products, so what is being produced and which of these products can we link to those SDGs. But also very important, how do these companies operate? Because ultimately that is also what matters in the SDGs. Reduce inequality is a very important one. Sustainability of production and consumption. So if we think of a product that might in itself contribute, but is made in sweatshops in Bangladesh, that is not what we're looking for. So we look a few levels deeper to really assess how these companies that we invest in contribute to the SDGs. And then lastly, there is a check on controversies. I think, for example, about banks, very topical also here in Australia. Clearly, there is positive contribution to certain SDGs, but if a bank is actually confronted with a lot of controversies, yeah, that is probably not the investment that you want to make. That is not in the interest of the SDGs. So literally what we have come up with is more or less a rating system, where for each and every credit, each and every investment that we can make, we give them a rating, whether it has a positive contribution, neutral or negative. And we also think in terms of the impact. Is it in the margin? Does it even have a negative impact or a very positive one? So to give you a few examples and just to highlight the complexity, it's not about the details here. If we think of financials, at first we can map those to SDG 1, 8 and 9. Talking about poverty, but also talk about the overall framework for people to start a business, for example, which is usually positive. However, we feel that it's particularly relevant for those financials that are active in emerging markets. This is where they can have that very positive impact on achieving these SDGs. And particularly if these companies or these banks focus on small, medium-sized enterprises. An investment bank, very different case. So we filter out those banks where a majority of their activities, so again we've set KPIs for these kind of statistics, majority of the activities is related to these SDGs. Another example is in the food industry. Again, you can link that to zero hunger. However, if it is a Coca-Cola, that's probably not what we're looking for. Yeah? So we already know that sugar is one of the major issues for the next 20 or whatever years. So we already want to encompass that kind of information in our filter. Yeah? So we look at how much of that business is related to healthy foods. And also how we think of alcohol and again EM sales as the key factors, the key KPIs that matter. As said in the second step, how we filter for how that product comes to the market. And so very much business practices. So it is about code of conduct, but also labor practices to make sure that there is alignment with the overall thought process behind the SDGs. And again, we then have to check for the controversies. So what does that mean? And how can we play a role as an asset manager? We actually, together with a client, we set a new investment universe. So out of a total universe, like your benchmark, we set a subset of companies that actually has a positive bias, a positive link to achieving these SDGs. And as we know that ultimately we are in the market to deliver return, to deliver excess return, we can then apply a normal credit process, for example. So we feel that in this way, we can marry the positive SDG angle with still probably one of the most important targets of most of the asset owners, and that is to achieve return. So those two can go hand in hand. It doesn't have to go at the expense of the other. Now, portfolio, and just to give you an idea, there will definitely be major biases in a portfolio compared to any other credit strategy, for example, that you would be investing in. So there's a big bias to healthcare, pharma. But on the other hand, in food, if we look at the global universe, there's very few companies that really contribute at that level that we're looking for to the SDGs. And then the last step, and I'm sure we'll get some questions also on that later on in the Q&A, and that is engagement. We feel next to your investment decisions, which companies to invest in, which sectors to invest in, it's probably as relevant to engage with the companies. Now also there we have chosen to make that engagement process very thematic and to target specific SDGs. And there's a few mentioned here. It's actually a longer list, but these are probably the ones that, it's quite clear what we're trying to achieve here, to really align the interests of the participants, of the asset owners, with the investment process. I'll leave it to that, and we move on to
thanks, Maurice. Just while you're there, we'll just give you, oh, sorry, everyone, please. Just a quick question from the audience to follow on from your excellent comments. What about smaller funds? Can you share a view on how smaller funds can have a meaningful approach if they don't have internal expertise?
Yeah, and I think that's a very relevant point. And indeed, most of my comments in terms of the experience that we've had with working with asset owners, those are the very large asset owners that indeed do take a leading role in this. But again, and this is also one of the initiatives of PRI, for example. Ultimately, we also try to educate, we try to learn from each other. So I think the smaller funds will be able to mimic some of this or benefit from the insights of the large asset owners quite quickly. And this is also where we see our role as an asset manager and to work with smaller funds and provide them with maybe somewhat more standardized solutions, but at least also for the smaller funds, to be able to align themselves with the SDGs.
All right, thank you. All right, so I'll just ask a couple of questions from some of the things I'm interested in, if that's okay, and have seen globally, and then we'll have more of a general discussion. So very quickly, Daniela, I'm interested in, has HESTA considered how far they would go in the pursuit of an SDG? Is it primarily a capital allocation discussion, or are there other activities that you would perform? For example, company engagement, policy engagement, collaboration with your peers. Is this an active conversation?
Absolutely, and I don't think that we've actually, as we developed our strategic goals, there's not necessarily a target. So we're in the process of thinking how we apply this to our investment activities. And we're already applying it to our active ownership activities. So what I probably didn't mention is that when we did this mapping of all our investments, that included a mapping of all our engagement activities and engagement activities undertaken by our engagement providers. And we aligned those with the SDGs. So that involves our active ownership, engagement activities, and also as part of this broader concept of Hestia Impact that I mentioned, it tries to put together what we're doing from an advocacy and policy perspective, as well as how we, as an organization, from an operational perspective, impact the SDGs.
All right, thank you. And Maurice, it was interesting in your comments talking about proportion of funds allocated to SDGs. So I want to ask you a question we didn't talk about before the session that comes to mind. Should we think about all investments as having some kind of SDG impact, be it positive or negative? And if you take on a commitment to pursuing the SDGs, is that actually your sphere of obligation to understand the positive and negative? And if it is, how far away from being able to perform that properly are we in terms of data and comparability between the metrics?
I would think that would be the ultimate goal, to indeed, if you really want to align yourself with achieving the SDGs, would be kind of odd to say I only carve out 10% of my portfolio for that. But it does show you that we are still in that early adaptation phase. And I think it's particularly relevant that for most of the asset owners, they're still internally looking at the trade-off between alignment with SDGs and returns and their regular investment process. So I think that is probably why nobody has come out like I'm going to allocate 100% of my funds or my assets to achieving those SDGs. So I definitely believe we might be moving towards larger allocations, but not at this stage.
Okay, thank you. I have some questions here, but please raise your hand if you have one from the audience. Okay, let's go to the audience. Thanks.
Thank you. Presentations. You would think that the implementation of would parallel with government policy, but that's clearly not the case when you see the US moving away from Paris. And indeed, in this country, 2 weeks ago, we lost the Prime Minister over clean energy and affordability. So if that becomes a trend where you see government moving away from these principles rather than embracing them, what do you see the long-term implications of that being in terms of how investors look at the future compared to how governments look at the future?
Yeah, what we have been talking about with some asset owners is that actually they feel they need to step up exactly because of this. They feel, and that is also partly the whole initiative behind UNPRI, to make sure that it's also the private sector that starts to contribute to this, that this should not just come from policy and from governments, but really the private sector. There's no way that the government or the public sector will be able to fund all of this. Not suggesting that there is no conflict or there's no issue therefore, but definitely I think this is also then the time for the private sector to step up.
I think it's also important for us to think of the timeframes that we're talking about. And many times we see federal governments having shorter timeframes. As long-term investors, we have to expand that time horizon to whatever's happening in politics right now. And I think that there's other forces, and in the US, yes, it's clear at the federal level, there doesn't seem to be a clear commitment. But if we look at the state level, the story is different, and California is pushing and they're implementing other sorts of policies that are contributing to that longer-term view. So, well, obviously, ideally, we would like government to be fully aligned with this long-term view of what we think it's a sustainable economy. I think that even if we don't have that right now, we have to keep that longer time frame in mind.
Okay, thank you. Question that came up on the screen, and then we'll go back to the audience, forgive me. And it got 2 thumbs ups, so I feel compelled to ask it. Has HESTA assessed whether or not the SDG focus has impacted fund performance? Have you done it historically, and have you tried to project forward?
So the answer is we have not done that work. We're very early stage in our work on the SDGs, as I think everyone else has. And so therefore, I don't have enough data to answer.
Okay, if we have a minute, maybe someone who has done it in the audience can contribute, but let's go to this next question, please.
A question for Daniela. As a trustee director, I'm interested in, and I chair AIC, so I'm interested in the allocation decisions that might stem from your work. So the question is, if it sounds like you've mapped your existing portfolio for the influence on SDGs and the relevance, is the next step, or have you already, has the IC already considered making active new allocation decisions to capture more SDGs in the portfolio, or is that the next step?
I think that's potentially, that's definitely something that conversations internally at the management, like in executive level at HESTA, and I think that potentially that is the conversation we're going, but at the moment we're in the process of thinking how we do this. And there's a few considerations. So one of them is thinking from an asset allocation perspective, how many, like the dollar value of how much do you want to devote to each SDGs or in total to the SDGs. But then there's another consideration, which is more not necessarily the dollar value, but also the impact that you might want to have. So instead of setting a target dollar value, you say, this is the amount of the impact that we want to have. And it's a different conversation, because investing, for example, in a small tech company might solve and have a massive impact with investing maybe 1 million versus investing 100 million in a specific infrastructure asset. So it's a bit more, it's not as straightforward as saying, yes, this amount for this SDG. So it's definitely an ongoing conversation. I don't think at this point we have an answer of how we're going to do that.
Okay, I don't see any other hands in the audience, so I'll go back to the screen, and we're quickly running out of time. One of the fundamental issues is whether one should measure where the opportunities are, as we discussed very well in both these presentations, but should one also measure the consequence or the impact of you making an allocation? Did the goal move because of what you did? Do we need to measure both, and how successful are we doing it now?
I would say that for the second part of that equation and measuring the impact, that we're not there yet. I think that is a massive challenge for all of us to really determine what we have achieved with this. So we know that we moved the dial or the needle in the right direction, but that's probably as concrete as we can make it at this stage. That's fair. Yeah.
Daniela?
So I think potentially one of the underwhelming things of this conversation is that we don't have enough data to assess a lot of this. And while we're measuring, for example, whenever there's an investment in renewable energy, some of our managers are reporting on the CO2 emissions avoided. It's still hard to understand the net impact. And we can only use proxies at this point, like at the overall ESG score of a company. That's a way of measuring.
Great, all right. And so this is one of the interesting things in the evolution of ESG integration to thinking about a goal-oriented framework. It's not just assessing whether a company has a good process and whether you have a good investment process to find them. It's understanding whether the company's products, services, practices, as Maurice was saying, does some good. So big business opportunity here, understanding the sustainability of capital flows in the next few years. If you would, please thank both of our very generous and open panellists today.